All right. So first and foremost, a very, very warm welcome to everyone. Thanks so much for taking in your time out and joining. And this is again a part of our webinar series, which we conduct every month, a couple of times or more, right? We call the series Deep Dives with IIQF experts, where experts from the industry comes and shares their knowledge and discuss about various important topics. So today's topic is careers in derivative pricing, valuation, and risk modeling using AI, their paths, skills, and strategy. And to take us through this today's topic, we have Sanjay Bhatia. Sanjay, thanks for joining. Just to briefly introduce Sanjay before I hand over the session to him, Sanjay has done his MBA in finance and also an MSc in machine learning and AI from Liverpool John Moores University. He also has a PG diploma in ML and AI from IIIT Bangalore. Sanjay is a risk management and analytics professional with more than 16 years of mainstay experience in risk models and methodology space, encompassing Basel, Advanced AIRB, IFRS 9, IMM, SSCR exposure, XBA, FRTB, OTC derivative pricing, and other advanced modeling topics. He has previously worked with various foreign banks, Barclays, RBS, Credit Suisse, UBS, now in Citi, primarily in risk consulting. He is also very passionate about imparting practical model understanding and insights and has been a professional trainer for corporate and investment banks. His areas of interest are credit and counterparty credit risk, market risk, stress testing, stochastic modeling, quantitative finance, and machine learning, of course. So before I hand over the session to Sanjay, maybe a very brief laydown on how we would go about the session. As you all know, the session is for a period of about 1.5 hours, almost 2 hours actually, right? So where actually we would first speak on the topic, which Sanjay will take us through, and then post the topic, we would have a Q&A session. So all participants can put up their questions in the chat window. Unfortunately, the participation is quite big, so we would not be able to allow you to speak up. But nonetheless, we want the session to be very interactive, so please feel free to type in your questions now or during the session or after the session, whatever you want to ask, or whenever you want to ask, please feel free to type in. We'll take up the questions post the session during the Q&A, right? So with that, I will hand over the session to Sanjay. Sanjay, allow me to make you the presenter and then we'll start the session.
Sure, Nitish.
Yes, so I've made you the presenter. Please feel free to start whenever you are ready.
I hope my slides are visible.
Yes, slides are visible, screen is visible, yes.
Yeah, okay. So first of all, a very warm welcome to everyone for joining this exciting topic, which has been on the forefront of AI ML disruption, right? In both the trading space as well as the modeling and analytics, which support the front office algorithms. Uh, when it comes to maybe the change in the landscape, the kind of maybe how real time analytics and real time trading in the market is changing the ball game. There's no doubt that AI ML and the disruptive algorithms which AI ML come to, bring to the table have a big role to play, because they add, capability to process big data. That's the big message. They have capability to do the real time analytics. They have capability to do through various architectures and computational power techniques, like maybe distributed computing or parallel computing. They have capability to solve a complex pricing and valuation problem, unlike many traditional statistical and numerical methods. So the key message before we start, which will be hanging on the chart while we go through this landscape, deep diving into this topic, would be uh, big data, analytics, high frequency data which is streaming, and use of alternative data set in pricing and valuation models, uh, producing real time analytics, real time pricing solution, real time valuation, real time hedging solution, real time analytics to support the derivative portfolio risk optimization, as well as maybe a way of building a model which is purely data driven instead of the typical traditional conventional models which were a bit theoretical based, a bit assumption driven. So that is what will constitute the topic for today. And in this context, we are going to talk about the first, how fintech and also the evolving regtech. Regtech is techie arm of, or techie outfit of the regulation, right? How that is going to shape up or pan out over the coming years, and how that is going to first of all set the market infrastructure which is required. So fintech driven revolution, as well as the regtech, how regtech is evolving to control that fintech and to promote the market infrastructure in this new uh, uh, business opportunity which everyone is looking for. the we will go quite a bit because this is a complex topic. If you have heard of computational finance, financial engineering, quantitative finance, which is targeted at derivative pricing, valuation, derivative trading, derivative hedging, derivative risk management, this is quite a mathematical topic. But we will also maybe broadly covering the use cases which are being now targeted by these new species of model called AIML model, and a bit of a sneak peek view how it looked like when a AIML model is adopted for derivative pricing, valuation, hedging, and risk management, which facilitates the derivative trading. How a AIML model design and architecture would look like, and what are the advantages, merits, the competitive edge or cutting edge of that particular AIML driven pricing solution, right? Or the pricing algorithm, right? So then we will go into where maybe it would interest you more, like from a career standpoint, right? We are at maybe a junction where, and people are confused like which direction to go in, right? AIML is now a buzzword. It is a cliché in every industry sector, but more so in financial BFSI sector, and there are multiple other domains, subdomains, maybe like algorithmic trading, risk management, portfolio management, as well as which is sitting alongside derivative pricing and valuation. What is there in derivative and pricing valuation which is making this career a lucrative option? What would be the career pathing towards such kind of roles? What kind of core skills, core competencies that would be required for somebody to build up a career? Joining these two kind of core elements, like uh, you know knowledge of AI and ML, as well as the domain, derivative pricing and valuation, which is in itself very intricate domain, right? We will also maybe a bit talk about, right, in an interactive way on the career growth strategy, right? How one should plan, how one should plan their journey, structure their learning, uh, and maybe a bit of parallelize, right, both the domain understanding, the domain skills, as well as the core competency and understanding of various numerical and AIML methods which are being applied to develop the pricing and valuation. So we will talk a lot, we will have a lot to cover. So first I'll start with this slide, which is not that complicated to understand, but I'll just go over it. So this is about pricing quants. So pricing quants, those quants who are working in front office pricing, They are looking it both as an opportunity, as also they are fairly excited about this opportunity because now they would be more valued. Since if you have heard of a concept called human in loop, right? Human in loop. So most of the complex models will now be developed using various artificial intelligence and machine learning techniques with human in the loop at multiple levels. Like if you are developing a model, you know there would be a human in the loop. If you're training a model, there would be a human in the loop. If you're calibrating a model, there would be human in the loop. If you're validating a model, there would be human in the loop. If you are backtesting a model, there would be human in the loop. If you're stress testing that model, there would be human in the loop. Now what does that mean, right? When I say human in the loop, that those experts who were sitting for long, right? Like they could not have a pure numerate or quantitative role or a modeling role, but they were very good with derivative understanding of derivative and how pricing works, right? How valuation happens in this space, would be valued as subject matter expert, because they would be required to ratify some of the decisions taken by the models and algorithms built in this space. So so the only thing is that they have to branch out themselves to understand the modeling world, the quantitative world, as well as specifically in the context of AI/ML, how which kind of techniques are, or which kind of on the shelf, off the shelf products, techniques, methods, right? Tool sets are heavily used, like deep learning or neural networks, or recurrent neural networks, or reinforcement learning. What all techniques would be used for pricing which kind of a problem? And the answer to that question is understanding the problem well itself, because the most of the uh, you know uh, misconception is that directly jumping to a tailor-made solution or some ready-made solution would solve the problem, right? Right, it has negative dividends, but the focus more nowadays is to have a lot of data scientists who will spend a lot of time on the market data, the pricing data, the volatility data, maybe also maybe a lot of alternative data set, you know produce the do the right kind of data mining, data transformation, uh, bring those data set and the insights which could be used to pivot your modeling strategy. What kind of model should be built there, right? Because the moot point over here is where I actually started, that this is a purely data driven way of doing modeling. So data is very important, right? Data is the new crude oil for this world, Brent crude oil for this world, fueling the whole world, right? So so the idea here is that a data scientist do play with the big data, do heavy data processing. They are very skillful in maybe statistical and maybe mathematical analysis of the data, like what is the distribution of the data, whether the prices are log normally distributed or is it a fractal distribution, which kind of, maybe what are different movements of that particular distribution, like measure of central tendency, mean, mode, median, or just an example, standard deviation, or maybe kurtosis, or maybe skewness. What are the statistical properties of the data, understanding that very well, and then visualizing complex data set. Now the world of derivative is not simple, right? They are they are When it comes to exotic derivatives, you would have, or some of the uh, uh, derivatives with a basket of underlying, right? A basket of underlying, or a whole, maybe a variety of or different kind of underlying put together in that particular basket, could have multiple multi-factor or multi-dimensional problem setting, where you need to understand what are the correlation between different risk factors, or how they evolve over time and how that correlation evolves, right? A lot of those things which drives the tails of the distribution, like where the price could go extreme, right? Price move in extreme direction, and you know for sure that a derivative trader is in love affair with volatility, is in love affair with extreme moves. So he or she want to predict the extreme moves well, right? And the models which are capable and which enable the prediction of these extreme moves, and when the prices will be completely out of money, derivative will be completely out of money, or you know complete in the money, or maybe deep in the money or deep out of the money kind of thing. So those kind of options, the pricing function should be built differently, the data should be analyzed differently. You need to model extreme events, you need to do tail modeling, you need to bring in a lot of things where correlation are happening between different risk factors, and the joint co-joint effect of that correlation take the price in one extremity or the another extremity. So that's why focusing on data, bringing in insights, right? Trying to mine as much data as possible. Try to mine alternative data sets. Like if carbon, environmental and climate risk modeling and carbon trading and decarbonization of the world is going to impact business valuation, is going to impact equity market performance. Why not to consider you know ESG modeling factors into derivative pricing and valuation? So that's why I said alternative data set, not just traditional what you have been looking, but looking, harnessing the power of some of the alternative data set, because the market is changing, right? Maybe the industrials are getting penalized for, their valuation would be going down. Industrials or traditional brick and mortar firms are going to penalize for not adopting what is coming new, right? So a lot of AI and machine learning investments in data centers has created a new industry called AI infrastructure, right? So as well as a lot of traditional businesses are also getting impacted by the environmental and climate risk factors. So there's a lot of data which is sitting there to be mined. Data is not the problem. Data and information, we have get past ourselves from data and information age. Now we are in a stage of analytics and quantitative modeling, right? Where we would be the competitive advantage would be to uh, use this data for building different capabilities, right? uh, and when somebody talk about AI, once these data sets are created, right, we could build those particular models which are purely data driven. The more data you have, the less theoretical model you would rely upon, the less assumptive model you would rely upon, right? uh, and the also the fact that financial data has a very uh, low signal to noise ratio. What does that mean? That although the data is huge, data is not the problem, but it is very noisy. In the world of high frequency trading or intraday trading or algorithmic trading, the markets have become noisier, right? Every time there's a spike and every time there's a blip, right? The only thing is you need to, as a data scientist, as a modeler, you need to segregate the noise, right, from the signal, because signal is what the real patterns, the real relationship which is going to make you understand how that financial time series is growing or evolving over time, be it the price or the volatility or the momentum or the trend or whatever. You need to pick up the right patterns. So that's why it is important for AI to harp on or to harness the right patterns, the right you know signals, instead of modeling noise, because noise could change anytime, right? Today noise is showing you up data in a certain way, but tomorrow, right, in a ferocious way. it could completely change your data distribution. So how to denoise the data is one of the major consideration for AI models, which are being adopted for pricing, valuation, trading and hedging in derivative space, right? The other part is that with the AI capability, we could offer an autonomous decision making, how to do dynamic hedging, right? How to do dynamic hedging, how to dynamically change the portfolio constituents, do the portfolio allocation, do the portfolio optimization, do the portfolio hedging. So that could also be built. So the one part is that how we could less rely on theory or assumption, make data driven models, algorithms, choose techniques. The trends says that those techniques are favored which rely on uh, you know mostly on data driven insights, as well as has good capability to denoise the data, as well as they could you know they could maybe be built into some kind of uh, uh, algorithm which could be autonomously taking decision rather than adjusting the model time and again. If the market data changes, the model should change, right? uh, you know uh, if So that is called dynamic modeling. The model should dynamically parameterize, dynamically adjust itself, dynamically calibrate itself to the market data, and dynamically responsive to the market. Like if I would require some, portfolio allocation or portfolio optimization or portfolio hedging to be done, the model should be suggestive that okay, now is it time to change your portfolio weights or do diversify your portfolio or move out of some concentrated areas of the portfolio, or maybe hedge some of the part of the portfolio rather than keeping the position unhedged or naked, right? uh, and also maybe some of the trends from time series, financial time series, which show that maybe you know the things are becoming non-stationary and things are becoming heteroscedastic. Heteroscedastic means that the statistical properties of the data is changing every then and now, which was not the case previously, right? In last to last decade, but over last uh, decade and a half or 2 decades, we have seen that the distributional properties of any index, say S&P 500 index, is changing, every few years. So the data is not also stationary; it is dynamically changing. It means there's a change in the microstructure of the market. There's something happening. Some new themes are coming in the market. As I said, climate risk is a big topic. Adoption of AI in the success of the company or valuation of the company is a big topic. So there's the disruption is happening, and hence the valuation of different asset classes, right? And the kind of maybe market data around pricing and valuation of different asset classes is also changing in its dynamics. It is not going to be stationary, it is not going to be homoscedastic. So to uncover some of the non-stationarity or heteroscedasticity in the data, that is also a big ask, or the kind of direction of travel where AI and ML adoption is growing up. Then maybe harness big data. I explained that correlation, maybe among different factors, how maybe extreme moves happen, how tail behaves, require a lot of data. And anyway, generally, one thumb rule is that when you are dealing with a statistical model or traditional numerical models, there's a bit of theory. There's a bit of theory which simplify and you know and which reduces the ask for data, right? Because you rely on assume that okay, prices are log normally distributed. You don't just literally gather a huge amount of prices to establish what is its real distribution under a given market. So, but with AI ML way of data driven modeling, right? You are going to harness, you are going to exploit big data to understand what is the reality, what is the fact finding, what is the reality, what is the real distribution look like. Is it stationary over time, or is it non-stationary? Is it homoscedastic over time, or is it heteroscedastic? Right. So a lot of data would be required, right? And then maybe today, the complexity in derivative trading and exotic derivatives, the use of exotic derivatives even in emerging markets, the markets have evolved. People have started using American options, Bermudan options, many time dependent options like American options, Bermudan options, uh, or digital barrier options, and many part dependent options like Asian option, or maybe digital barrier knock in knockout options. So what I'm essentially saying, that gone were the days that emerging markets, the trading, derivative trading, how it is happening in emerging markets is limited to plain vanilla European call and put options. There are different complex swaptions, different complex time dependent and part dependent options which are now being traded in the market, and hence the uh, simple use of black shawls, which was very much prevalent previously, now requires a lot of even emerging market banks, broker dealer firms, or traders to develop complex capable model which could you know uh, you know uh, model the non-linearity in these options. Exotic options, the payoff function is non-linear, right? The standard plain vanilla European call and put option, the payoff is pretty linear. So you could use some kind of analytical formula like Black-Scholes to reach out to an approximate price, but that's not the case with exotic or non-standard options, right? So these are the promising prospects where AI is surgically striking, right? Solving problems, some of the low-hanging fruits first, and then maybe moving, from strength to strength to see how to solve very complex high-dimensional problems, right? But we should be aware while building or training or deploying these complex and intricate models, and in the spirit of doing real time uh, analytics, real time processing, real time pricing, real time valuations, we should be very well aware of pitfalls of AI. These are very data hungry machines, right? Or any method or any technique requires a lot of data to train the model, to parameterize the model, to calibrate the model, to backtest the model, to validate the model. So unlike your statistical or numerical methods, a lot of data requirement to would grow. Hence also the need of you know capable data scientists, because it is very different. Like maybe a lot of a huge amount of data would be used for training the model. And generally, the second point pitfall of AI is they generally tend to overfit the data and overlearn. They are like those uh, algorithms which would try to learn even from noise. If you have not denoised the data, they will not segregate whatever data is telling them. They will try to learn every single thing minutely. So we need to be very careful with data, that our data should be clean enough and denoised enough, should not have any anomalies, right? And when we present it to uh, the model, we should have some way to keep some checks and controls, checks and balances on what the model or algorithm is learning, and what kind of maybe uh, how it is parameterizing, what kind of key factors it is covering, which is also goes to the fact that there's a separate study of AI which is called explainable AI. How to explain these black box model to regulators, auditors, validators, governance teams, right? That what they are doing and how they are doing it, right? Which factor they have considered to bring out this particular relationship or to predict this kind of outcome, right? So but you need to put a lot of checks on these models, because they generally tend to overlearn and overfit the data. They have a look ahead bias. They have a look ahead bias, forward looking bias, as well as some kind of data leakage could happen. Look ahead bias means that generally, uh, you know, uh, they give more weightage to forward scenarios than to what has already happened in the data, right? The historical scenarios, right? So they don't look that much backward, they look forward, right, in terms of predicting or simulating the profile of various risk factors which are evolving over time to price a particular option, right? So that's why, right, data leakage means that what you have already seen happening in the market, the historical trends, historical crisis, or historical scenarios, distress conditions, right? Learning from that, right? So if data, they are going to uh, having the forward look bias or look ahead bias, they are going to more lean towards, right, simulation, similar to Monte Carlo simulation, right, then any statistical learning which heavily rely upon what has already happened and trying to build the models, be assuming that that thing could happen again, right? History repeats itself. But AI models, AIML models, more or less like numerical methods, Monte Carlo methods, are more leaning towards forward-looking, mm, models, or having a look-forward bias or look-ahead bias, right? That's why a lot of properties of the data, right, which have historically been captured while doing uh, 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 preparing the modeling data set will get leaked, right? Explainability and performance attribution, that is very important topic for when you try to seek approval of any AIML models from anyone, like model governance forums, model audit forums, model approval committee, uh, you know external auditors, regulators, right? Your maybe risk portfolio risk heads, right? When you try to adopt this model, you need to seek regulatory blessings, you need to seek audit blessings, you need to seek business blessings, you need to seek approvals uh, for from a lot of different a lot of different stakeholders, so to say. And for that you need to prove uh, that this model is really intuitive, you know uh, and is tractable. It provides a analytical, attractable way of knowing that the output is this, and just tying it back, to the inputs, right? So uh, that's very difficult thing with machine learning, because generally AI and machine learning, these are very black box model with complex functions, and sometimes they have a very uh, they are known to give very high precise predictions. But if you just try to trace back those particular predictions, what kind of specific factors, right, contributed to that particular predictions, you do decomposition, right? Like which particular uh, you know principal factors are responsible or contributed to a good prediction, and maybe which were playing less contribution, marginal contribution to that uh, the prediction or output which they have generated. It is very difficult. So that's why we use game theory a bit, and it is under explainable AI, where we try to use Shapley values, which is based on game theory, to explain the output of these models, whether it be neural networks, it be support vector machines, some of the very complex non-linear models which are known for solving complex problems. They are equally difficult to explain. They're equally difficult to do performance attribution, right? Like how these models are performing, which particular factors or principal factors or variables are most significant in these models. So we need to employ certain specific techniques which are tailor made to for explainability AI or explainable AI, right? For better interpretation, for better intuition. So this is just set the broader contours, right? But now uh, you would definitely be interested in what is the uh, uh, you know uh, direction of travel, how things are going, and how the markets are evolving, right? So For derivative pricing quants function, which include the front office quants team, which supports the building and pricing and valuation of these models, and some of the middle office and back office quants team, which uh, build the model for hedging, for risk management, right, for like capital allocation or loss forecasting, as well as for portfolio optimization. So uh, you could see the derivative quants being in three, offices. The front office will quants front office quants would support the pricing and valuation function, pricing and valuation models. The middle office quants will do the portfolio management models. The back office quants will do the risk management and hedging models, right? So the quants could be in front office, the quants could be in middle office, quants could be in back office. But how this together, let's call it derivative pricing quants, right? uh, the sense of direction is and with the uh, mm, whatever you call it, AI bubble or not, but this is for real, guys, that maybe a lot of the disruption in AI has paid huge dividends to many companies, to the extent of that fintech is now considered is posing a threat to the main Wall Street banks, right? So a lot of these fintech companies, which are majorly driven by AIML at their core, and using them for pricing, valuation, risk management, hedging problems, right, is uh, uh, driving and disrupting the mainstream, Main Street, Wall Street, High Street broker dealer firms, High Street funds, investment funds, hedge funds, uh, you know, managed funds, pension funds, endowment funds, sovereign wealth funds, right, arbitrage funds, right, a lot of these fund investment space, a lot of broker dealers, a lot of investment banks, a lot of market makers, a lot of you know uh, the IB arm of a big global bank is being shaken up, and they felt the tremors, under the beneath the feet, that a lot of these fintech companies, how they are changing the market and quickly have a quick go to the market and producing real time pricing and real time analytics, and trying to grab a big share of the market, which is getting snatched away from them at a lower cost model, at a high maybe a propensity model, which could make them better go to market strategies, offer pricing quickly, offer bid and quotes quickly, right? Do more of the market making function, trying to price even illiquid securities, right? Some of the areas where these traditional big elephants were very slow, right? They have been challenged, right, by these nimble fintechs. And the theme is same: how to build autonomous, means uh, those models which can adjust themselves automatically, right? They need not to be every time with the screws, tighten the screws. They need not to be every time manually redeveloped, manually reparameterized, manually recalibrated, manually back tested, manually validated, a way where the model in itself correct or adjust itself, right, according to the dynamic market situation, dynamic scenarios, change in data, change in microstructure of the market, right, a lot of those things. So autonomous means uh, the capability of the model to take decision all by itself, with least of the human intervention. And obviously the human would be required in the loop, but they would be providing oversight, they would be providing ratification of the decisions taken by these autonomous algorithm. Most of the autonomous model have the capability to readjust the rebalance the portfolio, hence doing portfolio optimization and portfolio allocation, uh, you know uh, changing the hedge ratio of the portfolio, right? Also maybe taking decision wherever the concentration is, wherever there are heavy concentration, where the risk is coming from, how to optimize those particular positions, right? How to diversify the portfolio, right? So a lot of autonomous decision which we require, for running the derivative function, could be taken by the models, and those autonomous way of building the models or algorithms is the competitive advantage nowadays, right? That's what fintech has proved. There's a proof of concept. The dynamic means that these pricing algorithms or prices should adjust themselves with the changing market data, with the changing market conditions, with the changing market scenarios, with the changing market behavior, using some of the sentiment indicators as well, some of the uh, you know climate risk variables or factors as well, considering some of the AI factors as well, how AI adoption is impacting the company's valuation or asset class valuation across the board, because eventually the underlying is either the equity or any fixed income security of that particular company. If the company get affected, maybe the valuation of those securities will get affected, and maybe how maybe these bigger themes are impacting the prices, right? As well as maybe dynamically adjusting to that, right? So it is a game changer for valuation, pricing and valuation, and trading deals in investment bank. So much so that there are few uh, radical trends, I would say. There are few structural trends. These are not just fads. These are not just short-lived trends. These are not just seasonal themes. The fintech-driven AI and ML adoption in this particular derivative trading space is anticipated to grow from 13 billion very recently to 40 billion by 2030. So that's almost three uh, three times increase, right? Over a 6 year period, right? It's humongous, right? You could see that how much more models would be required, how much more pricing quants would be required, how much more data scientists would be required to build these models, to support these models, to validate these models, or to you know uh, enable the quants function in order to be able to handle that kind of trading volume, right? Or that kind of expanding portfolio, right? uh, the the focus areas of most of these fintechs are doing producing adaptive, dynamic, efficient algorithms which will efficiently price any options and replicate the option price, be able to very uh, you know uh, uh, efficiently price path and time dependent options or derivatives, and be able to dynamically and effectively do portfolio management or portfolio hedging. Some of the disruptors, right, which are you know in this space are basically arbitrage funds, quant funds, hedge funds, hedge fund global family offices or private special purpose vehicle pools, proprietary trading firms, high frequency traders, high street broker dealer firms, and many of the big and boutique investment banks. Now these banks have over last 5 to 7 years have invested huge sums of money in AI, ML, data science, big data capability, right? Hence, now is the time. Next 5 to 10 years is the time to for them to gain bigger share of the market and facilitate what this kind of a trading where maybe we have a three times growth by 2030, right? Right, and the some of the areas where these fintech firms are different from the traditional firms, or some of the fintech solution providers are different from the traditional solution providers, is that they harness alternative data set very well. They do mining of alternative data set very well. Satellite data, they use a lot of image data. That's where convolutional neural network comes into play, right? Aerial and drone data, signal data, right? They use it very well. Social media data to build sentiment indicators, IoT data, right? Internet of Things data, energy data, right? Energy supply and demand, weather, climate, and carbon footprint data, as well as geolocation data. Some of these data sets, right? Uh, it's difficult to think through, but uh, for some of these new asset classes like carbon trading, right, or maybe green bonds, right, which have so far been illiquid, and they are getting regulatory blessings as well, because they will open up a new market where the people will become take some climate sensitive actions and start trading in this carbon trading or carbon credits, right? So a lot of these areas would require a lot of different form of data or alternative data sets, right, to price maybe those particular green bonds or those particular securities, green securities, which are have started trading in the market in euro in a big way, and the derivatives is a way. One should always remember that derivative came into being not to speculate, not to arbitrage, or not to hedge, right? They came into being as a price discovery mechanism, right? The first thing was that they were used in weathers, right, when they started, right? The first thing was price discovery mechanism, something which you could not price, any random variable or any instrument which you could not price, or any event which you could not price, what kind of insurance premium I should pay for covering myself against this kind of calamity or this kind of catastrophe, or maybe something like that, right? Something you want to price, you want to calculate the premium or the price, right? you know Derivative allows you to galvanize a market, which allows different people to take exposure, synthetic exposure to that uh, you know uh, asset class or a new event or risk, right? And hence, when people take synthetic exposure, they start trading in derivative, you get a lot of data, right? How the market will price that. So pricing require data, right? Right. So derivative is a way, market making activities is a way to do the price discovery. It's a price discovery mechanism where you are galvanizing a market, captivating a market, which will allow you to gather data points which could be used to price the underlying, right? So today I'm just making this point because today it seems very far fetched, like how satellite data could be used, how aerial drone data could be used, how social media data could be used, how IoT data could be used. A lot of these uh, alternative data streams could be used, right? But the point is that the new asset classes, alternative asset classes, which are coming and gaining in trading, that's where the game lie, because that's where the huge margins lie, right? Big banks will not leave that particular segment untouched, because their first mover advantage which lies with fintech firms, but big banks or big street banks are going to pump a lot of money into these alternative asset classes. The only problem there is illiquidity and difficulty to price due to illiquidity, due to the data not being available. And big banks have this are these market making firms. They could open derivatives, they could sell derivatives, right? And if they are going to sell derivatives, they are going to captivate and galvanize a market, which will allow them to gather a lot of data, right? uh, to build models how to price these illiquid securities, instruments, or asset classes which are going to gain in trading, right? So that's where the market is going. That's where maybe the sense of direction, right? And maybe just a flavor in general about machine learning and the journey of machine learning. When this whole uh, quants area of quants or area of numerate field, quant is called numerate field or analytics field. It started long back. It started with descriptive analytics, which only used to describe, summarize, and analyze historical data. Nothing more. It used to tell what has happened, right? Right? By analyzing the historical data, assuming that the history will repeat itself, right? Then come the an era which was diagnostic analytics, not an era, but a next you know wave which was diagnostic analytics, where maybe the more interest was whatever happened, but why it happened. So it a more focus was on diagnostic analytics, finding the root cause of what were the drivers behind what has happened, like any kind of crisis, any kind of extreme moves in market variables. If they have happened, that is not enough for us to tell that has happened, but also to tell what led for such things to be manifested, like what really, what were the drivers, what were the variables, what were the factors. So diagnostic analytics. But isn't it this whole thing is backward looking? We were using historical data, using historical events, historical price moves or valuation jumps or whatever, right? Price jumps or whatever, right? And trying to tell what happened and why it happened, right? The the switch in the era happened 20 years or 25 odd years back, where we started this uh, numerate or quants or analytics paradigm, and from backward looking to forward looking. Now we have a forward looking bias, both as a modelers, quantitative professionals, as well as the model themselves, because the kind of techniques which are favored, the kind of methods which are favored, the kind of signals which are built more into, or factors or variables which are built more into the model, are mostly forward looking, right? So it started with predictive analytics, what could happen, predicting the future outcomes, right? It uh, it is currently we are in a phase in between predictive and prescriptive analytics, right? Where uh, we are efficiently or maybe effectively able to tell what could happen, right? But we are not able to recommend decisions, right? We are not autonomous. We haven't built autonomous model which could tell us how to hedge your portfolio, how to rebalance your portfolio, how to maybe remove concentration from your portfolio, how to maybe uh, change some of the uh, 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 sort of maybe all these kind of decisions, strategic decisions or operational decisions, like how to, when to go in a derivative trade, exchange traded derivative, and do a margin call, right? At what point to do a margin call. The models give you predictive output, but the models are, today's state of the models could not take autonomous decisions, right? Right. The decisioning part is purely subjective and led by humans, based on, by consuming the quantitative output or predictive output of the models, right? Now the point is this, that AI and ML present an opportunity to build these models and give them some leeway in order to take low level decisions, and with the human in the loop, right? Those low level decisions will be ratified by human. The human will be providing oversight and governance of those low level decisions, right? But definitely we are in a stage of prescriptive analytics, where we want the model to prescribe or recommend, right? What is the most optimal decision, right, under a given scenario, right? The final stage where we would be headed, maybe not now, 15 years or 20 years from now, right, is adaptive and autonomous analytics, where a world will come up like this. The algorithm will replace portfolio manager, money managers, asset managers, right? Traders. Traders have already started being replaced by algorithmic trading, algo trading. But broadly, most of the people, who are now manning these front offices and doing actual trading would be replaced by quantitative models which have the ability to be adaptive, be autonomous, and be able to monitor, decide, take action, right? Act autonomously or semi-autonomously, right? And maybe dynamically adjust themselves with the change in the market conditions. So that is the uh, direction of travel. But we will talk about maybe one of the use case maybe of deep learning, right? Building a deep neural network, right? How it is used for maybe some of the option pricing problems. So first of all, first and foremost, this area of you know derivative pricing and valuation, the bigger problem is maybe I have covered, maybe just give me a sec. I have covered it under some slide. Uh, yeah, right. So the bigger problem is the high dimensionality. High dimensionality means that for when the derivative becomes a bit exotic, a bit complex, right? Uh, then there are a number of parameters or which are required, high number of parameters which are required, uh, as compared to the kind of data we have to estimate those parameters. So data is, we don't have enough data, but the parameters required to completely specify the model, right, is are very huge. And every parameters are what? Parameters encapsulate the relationship between input and output, right? So, but in order for parameters to capture the relationship or key patterns or key signals, you need a lot of data, you know, because parameters could not be just based on I have seen this pattern and based on this, you know, these two things are related in this way, right? No, that's not the case. So the more the parameters, the more the data requirements. So some of the complex derivative problems have a lot of underlyings, a lot of factors, and hence in order to parameterize those models you require a lot of data anyway. That brings in the curse of dimensionality, that as uh, you know uh, you know you are dealing with these high dimensional problems, and as the dimensionality of the problem grows, the it requires more complex models to deal with that dimensionality. The calibration process, the parameterization process becomes so time consuming and so sensitive to the quality and quantity of data, right? Non-linearities generally, maybe as I told, that some of the complex derivatives have are time dependent, have time dependent uh, functions, or part dependent functions, or sometimes also they have a bit of discontinuous payoff functions. So their pair functions is either time dependent, part dependent, or discontinuous, right? So hence maybe we require some kind of a model, and neural network comes handy here, because neural network is generally called functionally a universal functional approximator. You give any complex problem to neural network, it could come out with a function, right? A universal functional approximator, right? And neural network generally, or deep learning, the area of deep learning often is good at handling the data sensitivity, right? Okay, the denoising of the data, separating the signals from the noise, right? Treating missing uh, data or outliers in the data, or maybe all of this. So we need, knowing the derivative pricing and valuation problem, and knowing some of the maybe uh, uh, advantages of deep learning and neural networks, it makes all the sense to use deep neural network. And hence, where here what you see is a DNN, right? Deep neural network model, right? So this DNN is a recurrent neural network. Recurrent means that a sequential way of learning, right? And there are two different variants: long short-term memory or gated recurrent unit, which we have used. And we have applied it on very high dimensional data, which means that a huge derivative portfolio containing a lot of attributes like different strikes, different barriers, different maturities, right? Different maybe underlyings, all of that. And this large and intensive market data, right, could allow us to do yield curve modeling or term structure modeling as well, or volatility surface modeling as well. So what I'm saying here is that neural network, when put to use on a large, huge data, right, could do wonders, right? Because it can, uh, as well as the kind of high processing power of a neural network, will bring in the idea of real-time analytics, because most of the calculation which are performed by neural networks while doing these pricing problems are very, done in a very vectorized way, right? So neural network can be trained by using parallelized computing, distributed computing, a lot of those kind of things, which could reduce the development time or runtime of the model, right? Hence, the go to market time, right? Like how sooner you could create a model which could price some kind of an instrument, illiquid instrument or exotic instrument, can be reduced, as well as the uh, for that time, the execution time, right? One is the go to market time, how sooner you could create these kind of models, and the execution time, how once these models are put into production, how quickly they produce real time pricing and real time analytics, that could be drastically reduced using neural network, right? uh, as well as neural network can take the event data as well. I told you the alternative data set, right? Now if event data means like we are building a sentiment indicator where we are using a lot of tweets, where opinions are being expressed by our different market pundits, analysts, observers, right? Traders, right? We could use the capability of the neural network to extract and process the textual data, the social media data, right? And make sense and build some indicators whether the market at any point in time is optimistic, pessimistic, or neutral about something like maybe the a broader index or asset class or a particular security. We could take advantage of sentiment, right? Sometimes, when the market are irrational, we call it irrational exuberance, that the fundamentals and technical charts would not tell you more, because people are in a herd mentality, and with some kind of a psychological thing, right? Financial psychology or financial behavioral factors playing into the trading, right? The sentiments take the market in one direction, and that's why the sentiment could also be harnessed as could be built into the model, and would allow you to predict prices well, right? So a lot of these things are possible using maybe neural network, right? And I have already covered a lot of these, but one point which I want to also tell you, that maybe the markets are changing very ferociously now. Gone were the days when the markets are calm. Everything in now a war situation, West Asia war situation, or Ukraine, Russia prolonged war, or maybe some kind of supply chain disruption, some Chinese intervention into this country or that country, maybe Trump tantrums, U.S. Floppy policy, all these kind of things had added a lot of volatility to the markets. And a lot of market, when the model is built, the focus is also, when I say analytics or risk analytics for derivative portfolio, our focus is also on to stress test that particular model under different market scenarios. market arbitrage effect, market liquidity effect, market leverage effect, wrong way risk, right? Asset price dynamics under prolonged market crisis. All these scenarios could be built in a scenario library, and the model could be refreshed under these under the such scenarios to see what is the under the stress market or stress conditions, what could be the price outcomes, pricing or valuation outcomes. So a lot of these coming together will bring in a lot of opportunities. But now let's talk about maybe the rules, right? How you could maybe read a lot, and maybe broadly I have included a lot more detail because this area requires a bit of joining of theory with practical understanding of how the market is evolving, right? And where we are and where we are heading for, right? So that's why maybe you could read through a lot. But uh, now let's focus on some of the trends, right? That this industry maybe uh, as on date, right? BFSI sector is pegged to save 1.2 trillion, 1.2 trillion, not billion, by 2035 using AI and ML. And the major area of adoption of AI and ML is in derivative pricing and valuation, trading, uh, because derivative pricing and valuation, I'm saying because it requires huge investments into building models and building front office, middle office, back office models, the and risk management. So a lot of adoption of AIML you will see. That's why you don't, you see that your board of directors or executive boards, or they are talking nowadays every in their town halls about AI and ML, right? The low hanging fruits were obviously large language models and Gen AI, right? That is going to optimize or automate some of the manual tasks, right? Or maybe bring efficiencies there. But the major uh, uh, cherry on the cake, right? Or maybe major lever to pull is in core areas of quants, quantitative or numeric discipline, where it is going. Maybe broadly, this 1.2 trillion, which is pegged by 2035, is going to come from quantitative or numeric fields, right? Now, the idea here is that if BFSI expect maybe BFSI by 2030, BFSI expect 22% cost reduction, right, in operating expenses due to AI and ML, due to variety of initiatives, right? And similarly, by you know World Economic Forum also predicted that maybe the data is growing every day to 500 exabytes per day, right? The job report by World Economic Forum also predict that the 85 million jobs globally will be uh, replaced, and 97 million new roles will be created. So there's a bit of worrisome sign or some kind of pessimism which direction it is heading for, just to maybe uh, provide clarity, because people just take react to things, right? They don't understand that it is it is a shift. It is not a replacement. A shift means this, that the traditional rules, purely traditional rules, right, which are lacking any expertise in analytics, modeling, quants, you know, generally maybe the know-how of broader AI and ML, are going to get affected, or in a way over time, you know going to get maybe out of favor. But a lot of new roles, both at the entry level, right, like data scientist role, data expert role, right, data analytics role, synthetic data expert role, right, algo model designer, algo AIML, product engineer, product manager, product researcher, right, model validator, model auditor, model governance team. A lot of new roles are coming, and those new roles far outstrip because the big banks are in a hurry. They are impatient. They are impatient. In foreseeable future, like in 15, 20 days, this game is going to change a lot. Whether the fintech will win over the game, or the big banks will, you know, reduce them to, uh, you know, to a particular share of the market and still hold the predominant share of the market. So so they are going to ramp up capacity, but a lot of job description or role families which I'm seeing to from last year or last to last year and nowadays is that it has a huge element of AIML. And some of the roles which are promisingly coming up offer good career opportunities as well as exposure. This is the right time in next 3 to 4 years is the right time to enter into the space, because this is still not mature. It is not going to mature in next 5 years, but around 5 years it is going to get mature, and then these roles and job role families will become very stereotype, like how you traditional roles are, that you need this X certificate, Y certificate, this X level of proficiency, this Z level of core competency to be there. Now it's a lot of an experimental phase, that whosoever is has a good level of exposure, good level of understanding, could be further trained on the job, given more opportunities to experiment, should be taken, right? Because there are not enough people to fulfill the demand. So I, from a career trajectory or career pathing or career strategy perspective, I would say that don't be a fence sitter. Don't be a fence sitter. In whichever way, uh, you could take some radical steps. You could take some, you know, with a sense of urgency, some, fastedness. You could be nimble and you could try to adapt and adopt to the new reality, because this is not just a trend. The data, the job market data, as well as the kind of business model, how they are changing and how they are getting disrupted and how the market is shaping up, it's not going to be a bubble, right? Maybe overvaluation is a different thing, that some companies which are purely AIML, due to a surge in demand, huge demand in the short to medium term, are overvalued. That's a separate thing, right? But don't confuse it with that. Okay, this is not a structural shift. This is a structural shift. This is not about some kind of a intermittent trend which will come and go, right? Once the bank will successfully adopt AI and ML into quantitative discipline or into any discipline, and build those autonomous, those dynamic capability of doing pricing, valuation, risk management, there's no there's no point in going back, because there's a supportive infrastructure. They have built data lakes, they have built big data platforms, they have built huge data infrastructure, data centers, they have bought huge computing power, right, for them to enable to run these models, or to make the execution real time for this kind of analytics, or this kind of quantitative decision making, data driven decision making. There's no point. There's no going back there. There's no going back there. Once the money is invested, committed, the infrastructure is rolled out, deployed, there's no going back there. It's just like today you say, I'm on a big data platform, Scala, Spark, Hadoop. The data demand is also growing. Shall I go and do PLSQL? No, Oracle PLSQL. Can I change my schema? Somebody would say, "Are you fool? You are going back to primitive era, right? For no reason." So there's no going back. So this is not a trend. This is not a trend. Definitely not a trend. This is a structural shift, and that we should understand, and plan our career journey. And the challenges, uh, many people have. The good part is all of us has. It's about when you onboarded the train, rather than maybe missing multiple trains and then wishing that you would reach that destination. So uh, plan your career moves. Plan your First of all, plan your learning journey, right? It uh, it doesn't hurt even if it takes 2 years or 1.5 year. That's a sound plan. The whole world is going like that. They are doing some kind of a good certification programs or some dedicated learning to learn this area, right? uh, Parallelly, also do not stop yourself from experimenting, you know. Trying to if you are trying to become a full-time quants or full-time AIML expert, there are many low hanging fruits which could give you right kind of exposure, right? Take those jobs, right? You know, which will give you some kind of a pivoted exposure in AIML and its application in various domains and subdomains of you know, risk, finance, treasury, whatever, right? And try to leverage that. You would automatically, organically, naturally develop that aptitude, that proficiency, that kind of positioning, which will make you leverage yourself in the market. The market uh, for labels has long gone, dear. So no, I am IIT tag. They are important. I'm not. They are very premier institute. They have created huge value. But now, the only skill work, right? Only core competency work. Even if you are a plain vanilla graduate, but you know how to do stuff, you are more valued, right? And that could be proved through your GitHub profiles. A lot of way how hiring is going to the hiring pattern, the hiring approach, and the interviewing process is going to interview evaluation or candidate evaluation process is going to change is also a thing. Like they would be asking for your GitHub profile, and they would be seeing what kind of body of work you have done there, right? How many data set you have analyzed. Have you done some kind of a modeling? Have you done some kind of a data analytics, right? And they might ask your GitHub profile, and the questioning and maybe the interaction would happen. What kind of projects, capstone projects or different kind of uh, experiment you have done around AIML use cases in one area or the other, right? uh, Rather than what kind of you hold FRM charter or CFA charter or this chart. The time has gone. Maybe very soon you will see that the dividends from, you know, any of these labels. I'm just broadly calling labels, right? Because you know these are good labels to had. These are good learning which made us reach where we are. But where the market is heading, the market has gone you know, past these labels, right? It doesn't really matter whether you have what kind of labels you have. So that's an equal opportunity for those as well who really believe in learning, really believe in learning rather than more of positioning themselves through labels, right? And if you are a, you know, continuous learner, you know, nothing is challenging, right? And maybe they're now since fintech has evolved, edutech also has evolved a lot in providing this kind of education and this kind of training and this kind of skills, imparting this kind of skills. All you need is just remember, when howsoever you plan your career progression or career journey, never leave your uh, domain, right? Your domain specialism is only also going to pay even higher dividends with you being an expert or human in the loop, in the training, in monitoring, in governance, in ratification, in decision making process. When a lot of these agentic AIs or robotic AIs or these algorithms are also, you know, joining hands with you, right? So an expert would be, a finer expert would be required who understand these models, who could, you know, correct certain things, decisions, so that from the corrected decisions models would learn again, and next time they would themselves dynamically adjust to give you a better precise outcome what you are looking for, that decision making. So autonomous decision making would also require some of the expert to actively participate and interact with the today's models, algorithms, agentic AI, generative AI, robotic AI, whatever you call it. These are just words to describe one or the other thing. But I'll rest there, and maybe there's a lot I could say. You could read through these slides and some of these roles which are coming up. Just last point, which are in demand nowadays are data scientist, right? Which is a role of uh, uh, somebody who knows statistics very well, somebody who know how to play with data very well, somebody who know data mining very well, somebody who know how to harness alternative data sets, how to bring in different types of data sets, not only traditional numerical data set, but textual data, right? Tweet data, right? Image data, how to do statistical analysis of the data, their data distribution, how to do data visualization, how to do data storytelling, how to produce insights present to a larger stakeholders like portfolio heads or business heads or your boards or whatever, right? How to inform them that okay, this should be the strategy, model development strategy, or the pricing strategy, or the front office trading strategy or hedging strategy, right? So a lot of data driven decisions require a lot of data scientists. A lot of data scientists would rely on a lot of data engineers to create huge IT infrastructure capability for them to be able to do it fast and efficiently, right? How to get a lot of API layers from Morningstar, from Capital IQ, from Fitch, Moody's, S&P, to bring in market data, rating data, whatnot, right? And maybe we need good platforms. We need stronger, maybe data infrastructure, robust data infrastructure to be able to. So, data engineer is a pure techie role in this, with an awareness of how whatever they are doing, what it is leading to, right? So the aspirational role for a data engineer is always to become data scientist one day. Then AIML developer, who is a pure developer, who is an IT techie, who develop, deploy, right? Optimize these models from a IT tech stack perspective. It is a front to back developer who know which particular, how to deploy these models, how to do ML ops, or AI ops, operationalization of certain development steps, right? AML algo designer is somebody who knows how to use the computing power, right? The GPU, the multi-threading or the parallel distributed computing to train these models, right? A product owner is somebody who wear multiple hats. He wear hat of the business, he wear hat of the risk, from where the requirements are coming, regulatory side, right? He or she caters to multiple stakeholders and bring the requirements to the whiteboard and plan the product design, right? Maybe product means model here, right? Okay, along with the IT, along with some data scientists, along with whatever constitute that particular, you know collaborative team, which in the agile way will start developing that model with the idea that they should achieve a faster go to market, right? AML researcher is a pure, not, I would say not pure, but a specialist role, which know AIML techniques very well, AI and machine learning techniques very well. Say if I say deep learning, if I say recurrent neural network, if I say artificial neural network, convolutional neural network, different kind of architecture from a methodology perspective, because he is the one specialist who would guide you. Okay, this kind of a problem, high dimensional problem, non-linearities, maybe some of the part dependency, time dependency, and the pricing you have to do, and maybe a lot of these things, you should use the choice of method from AML shelf should be this. These two three methods you should try on this particular problem. So he is an AML researcher who has spent years in doing some AML research and bringing in uh, you know the application uh, of AI and ML and mapping it to various use cases. Computational quantitative researcher, somebody who is in quant finance and now also want those quantitative models to be changed using the computing power is a computational uh, quant research. Quantum computing expert, very niche role, but that with the chip war, right, which is uh, on way semiconductor war or rare earth material war, we are moving towards quantum computing where maybe in the next decade, obviously most of the countries try to win this battle of quantum computing. And once the quantum computing would be there, the quantum computing will make your computing like a flick, like a blink of eye. It is so fast, right? AML, AML, program manager, project manager. Obviously, these are roles which have been currently there, but they need also to adapt themselves to know what AIML is all about and the broader application areas. But because it is not a agnostic role, it is not a generic role, it is a specialized role, a program manager or a project manager who knows at least this much, a helicopter view of AI and ML, what are the broader application use cases and what could be the opportunities and how to run a program or project successfully, right? So these are broader role families. But Nitish, I think maybe a quick time check and over to you to maybe take the proceedings further.
Wonderful, actually, like really informative session. It was, I mean, really eye-opening where we are moving and what kind of roles and opportunities that are available. And definitely we would go to the Q&As questions that are there. But very quickly, maybe to just to give you a breather as well and to utilize the time to quickly guide people on what they can also do to actually train themselves, because you have rightly mentioned, I mean, there's a lot of opportunity to train yourself and maybe to upskill yourself and like get the opportunities that are like low hanging and I mean otherwise as well. Okay. Um, so very quickly, I'll just run you through a few things. I mean, most of you already know that. I mean, I represent Indian Institute of Quantitative Finance, body which specialize in education and training in the field of this quantitative finance, financial engineering, data science, machine learning areas in finance, algorithmic trading, so on and so forth. And I mean, this entire field is like, again, it requires a lot of combination skills. I mean, mathematics, statistics, programming, and now machine learning, data science as well, right? So we have multiple courses to prepare you with different areas or different knowledge sets that are required in the industry, depending on what you want to, what areas you want to concentrate, what areas you want to learn, because we definitely believe the era is for people who have a strong understanding about the domain. Also, like again, you have a strong understanding about underlying data science, machine learning models as well. So the combination skills will work very well, and it is like, again, for those who would have domain plus the knowledge about the data science, machine learning tools, they actually will be a lot of it. Their roles will be, they would have like a lot of future proofing rather they will be doing a lot of future proofing their career as well, right? So I mean, in fact, instead of they should being afraid of like the AI wave, as a lot of people are mentioning, they in fact would be harnessing this wave, and they will rise further and further, right? So to prepare you for different areas of the quant industry, we have very strong uh, courses which are designed to prepare you for the different quant and ML data scientist based roles in the finance banking space. And good thing is this, all these courses that we have, right? I mean, these are all done in a way. I mean, these are all conducted in a way that where like you can do it along with your job, or maybe if you are doing a full-time degree program, you can learn along with your other full-time degree as well. These are all weekend online live instructor-led programs. You have a course called Certificate Program in Financial Engineering, a very heavy mathematics and mathematical modeling course, prepare you for the deep quant roles. If somebody doesn't want to go into very heavy duty maths, then and still want to learn the quant field with the theory and practical modeling and all that, there's another course in the same domain we conduct. It's called Certificate Program in Quantitative Finance and Risk Management. It's again a 7 months weekend program. And I mean, if somebody wants to specifically focus on learning about systematic trading and algorithmic trading, uh, then there is a specific course on postgraduate program in algorithmic trading, teaching you systematic trading and building algo systems using different kinds of strategies: technical analysis, price action based algo building, machine learning based algo building, quant model based algo building, and all that. Right. So, and then, of course, now is like again the era of AI, including our quant industry, data science, machine learning, AI. These are heavily used skills in this kind of fields. So we do have specific courses to train you to become a machine learning expert or a data scientist in finance. So with a course called AI for Finance, which is like the comprehensive full course, teaching the entire domain, data science in context of finance, machine learning in context of finance, and then teaching. I mean, you may choose your area of specialization as well. There are 4 electives which you can choose to specialize as well: AI for risk, AI for trading, AI for derivative valuation, and generative AI for finance. So those who are there in today's session, maybe AI for derivative valuation also is like a good area to specialize, because I mean we are all discussing about that field today, right? And if somebody doesn't want to do the entire AI for finance course, they can do part modules as well. They can do only the data science for finance part, which would be 3 months. They can only learn the machine learning for finance part, which is 4 months, right? And again, as I said, these are all weekend live lecture based courses. And for those who already have a strong foundation and background in data science, machine learning, and all these areas, they can directly go into this specialization modules. There are 4 specialization tracks in AI: generative AI for finance, AI for trading, AI for risk management, AI for derivative valuation. So those who already have good background in data science, machine learning, they can specialize in any of these areas. They can directly go into the specialization modules, right? And I mean, okay, I'm not skipping this space. There are many thousands of students actually have gone through our courses over the periods. A lot of them have shared their thoughts on how they have utilized these programs. I mean, anybody interested in like they can go to our testimonial page, but I'm not delving much into this. But again, very quickly, those who get interested in building a career in this field, right? I mean, doing a course or not doing a course is a lot later. But again, what we do is, I mean, whenever somebody gets in touch with us, right? I mean, even before they do a course, I mean, we do have a strong system and the placement support. Of course, I'll discuss that in detail. But even before that, right? I mean, when somebody starts this discussion with us, I mean, the domain experts from our institute, they discuss with you, understand your requirement, understand your background. There's a strong career counseling that we do as well. I mean, if needed, right? We actually can guide you in terms of like the direction that you can look at, what kind of knowledge that you can look to get. I mean, what kind of profiles you can move to. So basically, like our support system starts even before you start the courses. There's a lot of counseling that we do even before you join our course. We will help in selecting your course. And then, of course, once you are part of our to a program, there are a lot of other things that happens. The mentorship by industry experts, because in any case, all courses are taught by industry leaders like Sanjay, right? So they all are people who are working in leadership position in quant trading and risk management and all this relevant industry, and ML in finance or areas, right? So essentially, not only you learn from them, but again, if you need any specific guidance, you can touch base with them and maybe discuss your specific problems in terms of your overall direction and all that, right? There's a dedicated placement support team. Once you complete the course properly, they can help you in the entire placement process, starting from your resume building, profile improvement, LinkedIn profiling, then sending your resume to the right companies. The industry network, of course, is pretty strong. Being the oldest quant body in India, we do have a very good connect with the entire quant domain. The students over the last 16, 17 years, they have been doing wonderfully well. So a lot of them are in very senior leadership positions. They also do guide us in terms of job placements and all that. So they also help us, right? So essentially, there's like again, I mean, we use or try to leverage all of this and helps our students who complete the courses properly, right? Um, Companies and all, I'm not going deep into level. Of course, we can discuss in detail if anybody has any interest. So these are all target companies, hedge funds, international banks, investment banks, asset management companies, fintech companies, financial software and product companies, stock exchanges, the consulting firms, of course, the central banks and regulators, IT companies. So all of this can be your target. They are all heavy users of quant modeling and ML and data science areas in finance, right? These are again a different set of roles that you can target. Again, this is a very indicative list. I mean, we can go on and on. So I'm not going deep into this. Again, a very small list of clients, companies who actually would we have worked with. Again, the entire quant industry is a connect, but this is just an example. I mean, we do conduct a lot of sessions and events with the leading educational institutes to promote the field among students as well. Again, this is a very small list. I mean, the academic association has also now become very strong, right? I mean, we do a lot of things with the academia as well. All right. So, I mean, anybody who has any interest in understanding about this field or need any guidance, you can always call us or reach us through email as well. These are our contact coordinates. Okay. So now, like again, maybe we'll go to the questions one by one. Sanjay, if you're ready, I'll just collect the questions
Yeah,
for
yeah,
you.
sure, sure. Yeah, go ahead.
Okay. Gautam, well, will this document be shared post this webinar? Yes, Gautam, this will be uploaded in your LMS, so you can log into your LMS and you can see the presentation as well. And of course, the recordings of the session will also be later on updated. So you can you can look at the material, you can look at the recording, and those who are attending and actually can download your participation certificate as well. You can all basically like again yeah, I mean, if you log into your LMS you can actually see all of that. Okay. All right, so next question is from Milind, and he says that sir, I am okay. Those who are raising their hands, we will come back to you one by one, but in the meantime, if you have any questions or anything that you want to discuss, please type in the chat window and we'll come back to your questions one by one, right? So yeah, I mean, Chirag, Barguna, Manjula, we can see that you have raised your hands. So please do put up your questions. We'll come to your questions also. All right. Okay. So coming back to the question from Milind. So sir, I'm building an AI-based application for IB, private equity and quant professionals. From your experience, what real problems should I focus on solving to make it valuable? And if you're open to it, I'd like to stay connected and learn from your guidance. Of course, yes, Sanjay, I mean, any suggestion from your side? From your experience, what real problems should I focus on solving to make it valuable?
Yeah, yeah. So thanks, Milan, and maybe we are quite open to for any collaborative opportunities because the world is not siloed, and IIQF has always promoted maybe the research, uh, many researchers to come together and to build certain capability which would maybe could be leveraged by everyone, right? To answer your question, I think you said private equity. Quants
Yeah,
and
investment banking, private
IB,
equity, and
IB.
quant professionals. Yeah, yeah.
So the first advice would be that focus on not private equity, private credit market. The private credit market is far outstripping the private equity market, right? Because many of these companies who are trying to take a lot of private equity and going on the direction of getting public listed, uh, since COVID-19, there's a huge interest in taking private credit, and these companies preferably would like to stay private for long. Hence, private equity. could not provide that kind of gestation period because their exit is very defined. So they switch on to private credit, and that led to private credit markets. And you would notice that in many of the premier IB banks, investment banks, right? You would know that that portfolio now counts more than private equity. So try to focus your energy building something which is very futuristic, which is private credit, right? And so on and so forth. Many funds as well, right, which are float, which are for different institutional investors, and have now come up with a private credit fund, right? So build something for private credit market. And when you build something for private credit market, what is important is for you to understand the how the credit is priced, how credit derivatives are priced, right? And how those are used to value the company from a debt holder perspective. So you are a creditor, or you are a somebody who have invested in, just like a the analogous way of looking at it is like a bond investor in a public listed firm. You're a credit investor in a private firm, right? So how to price that, the NAV of that particular fund, how to look at different kind of portfolio management models, building in Sortino ratios, Trainer ratios, right? All those kind of things, that is going to pay huge dividends if you are working on this particular project, right? So track private credit, and there's a lot of research out there on private credit, many research papers out there on private credit. And where from a modeling quant's perspective, whenever you are building something, try to leverage the power of neural networks. Try to use to start with use RNNs, recurrent neural network, to solve these problems. It would help because they are easy to scale up, they are easy to be adapted to, a changing markets. Like if private credit would have some nuances which will come as it evolves, you would be easily be able to incorporate those nuances as you build the model or maintain the model going forward, right? So that is a huge thing, and there's a huge demand. There's a specialized funds with deep pockets in private credit, deep pockets, right? So it would be better, it would be easier to monetize that idea as well. Yeah.
Wonderful. Right. So I hope that answers your question. If you have a follow-up question, please feel free to type in. In the meantime, let's go to the next question, which is from Tanumay. And he says that time series we deal with linear regression. Will that be a problem? That's the question. I mean, did you
Yeah,
understand?
yeah. So
All right.
financial time series have been traditionally been used as a de facto model for price forecasting, even for volatility forecasting. So some of your models like ERMA, ERIMA, Gauge, Arch, eGauge models have long been used in this area for price forecasting, volatility forecasting, rate forecasting, and econometrics forecasting, GDP, GVA forecasting, industrial production forecasting, inflation forecasting, a lot of these things. And these models are not irrelevant. They're very good models. In fact, when we use recurrent neural networks, which are sequential learning models, right, which work on a price series, a sequential data, right? We The starting point is always a time series model, right? Even the EDA, exploratory data analytics, which we do as a data scientist to understand different properties of data, whether the series is stationary or non-stationary, the it is homoscedastic or heteroscedastic, right? The unit root analysis for identifying stationarity, all of this is based on using some of the variants of time series model to look at the data, understand it, and then to find how to leverage those particular things to build a RNN, sequential learning model. Now, where your question specifically is, I haven't yet answered your question. Your question is where it lacks, right? The it has a look back bias, right? So we want models which are autonomous forward looking, which could build multiple scenarios, simulate across multiple markets, right? Market scenarios like maybe any arbitrage, market arbitrage happening, any market liquidity situation changing, right? Any market volatility situation changing, right? The time series model are not the right models for that because they are linear, or they also are not very capable of capturing non-linearities, interactions, correlation structure between different factors. So, owing to this, if you want to build a dynamic model, a multi-dimensional model where you could capture a lot of interaction between different market variables which are impacting the pricing problem, then obviously you have to switch to a RNNs, recurrent neural networks, right? But time series model will stay relevant, right? Because when you do your analytics or data science insights, that's where you will heavily use these time series model, as well as you will benchmark the performance of your machine learning model, whichever you would use, against these time series model to as a proof of concept that okay, they are better, they are more stable, they are more robust, they are more precise, they consider a lot of non-linearities. So if your problem is non-linear, multi-factor, multi-dimensional problem, right, the starting point would be time series or multiple time series, right? And then you would be evolving, changing paradigm, change to this new world to price it appropriately, right? To forecast it appropriately. Yeah.
Yeah, absolutely. All right. So there is, I think that answers your question. Okay. So anything, any follow up, please feel free to put up. There's a statement from Kostov. Kostov, I'm not sure whether this is a question or like again, just a general observation. So he has mentioned like for quant commodity, there can exist derivatives and we can observe weather data, climate data, and other satellite imagery. I mean, it looks like more of a question, but if you have any questions associated with that, you can let us know. Uh, I mean, I'm going to the next question for the time being.
Yeah,
Okay.
just what Costa said that, uh, just for example, uh,
Yeah.
there's a thing called shale gas, right?
Yeah.
Which is an alternative to oil and gas, the Brent crude oil. Now, if a shale gas is in ENP, right, exploratory and production phase, right, you have to price it because before it start in the production mode and it comes to the market and it start replacing many of the fossil fuel or crude oil, right? Uh, how would you price it? Some of the satellite imagery data, what would be the supply side, right, coming from shale, how much it would dent the price of crude oil, right? So that would be required, but you would be first doing the supply forecasting for shale gas and then match it with demand, right, to see where the price will be established. So some price discovery mechanism, right? How to discover the price of something which is not prominent as on date, whether it is carbon dating product, carbon footprint products like carbon, trading products, carbon trading instruments, or green bonds, or maybe shale gas, or any renewable energy, right? Anything, you would need alternative data set if that's what you are asking. Yeah.
Right. So anyway, Vastav, as I have asked, requested, so if you have any question, follow up on that or follow up questions on that, please feel free to type in. The next question is from Subramaniam, and it's a very good question actually. So how this is going to impact internal audit and risk sectors in NBFCs? Management expects their internal audit department to act preventive to arrest frauds. How predictive analysis works? Kindly guide us.
That's a very good question indeed.
Yeah.
And Subramaniam, you know that forensic analytics is an area, forensic analytics, right? Fraud detection is an area, right? Where a lot of machine learning, AI and ML footprints have already established, right? How to conduct that forensic analytics or fraud analytics or AML, anti money laundering analytics, or even anomaly detection, right, in your balance sheet, P&L, right? Now the audit function of this big four, which has been very traditional and a paper trail, right, has also changed and uh, changed for better. That a lot of analytics is happening, a lot of models are used, right, in scanning the documents, in finding anomalies in documents, finding anomalies in financial reporting metrics, finding anomalies uh, where maybe there could be a uh, you know um, uh, book 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 cooking, right, if lack of a better word, right? Somebody is cooking the books, or specifically for those firms like who are trying to take a VC funding or private equity funding, that is very common that they cook their books, they cook their revenues, they cook their books, sale orders, or so this is very important that audit function is also changing and trying to use analytical models, right, to look at different anomalies or different discrepancies or different areas where the fraud could happen and where the valuation, the things are overvalued, uh, or those kind of things. There's no fair valuation of the things as it looks for different, while looking at balance sheet, P&L, cash flow statements. So a lot of these things are going to maybe indispensably come into the picture.
Wonderful. I hope that answers your question. Okay, next question is from Kostav, and he has asked, hello sir, are there any research internship programs that IIQF provides for summer or winter cycles or on rolling basis? So, Kaustubh, I mean, we do provide a lot of work we do with our students actually, right? I mean, for people who are outsiders, you can also apply. If there are certain available window, we can work. And I mean, if it sounds interesting, we sometimes work with outsiders as well. But mostly we work more deeply with the students of our different courses. But otherwise also, I mean, please feel free to reach out to us. I mean, you can email any proposal that you have in terms of research collaboration and all that. Like, if the team finds it interesting, even if you're not a student, they can still consider. All right. Okay. Going to the next question. Okay. So just I'm skipping few because they're repetitive. So just. Yeah, Kaustubh, and the document, if you're talking about the PPT that Sanjay has presented, yeah, it will be shared to all participants, irrespective of whether you are student or not student. I mean, if you have participated in this webinar, you can log into your LMS, and as a part of this webinar, you would get this material uploaded in that section. Okay, next question is from Samyak, and he has asked, what are the minimum eligibility can non-engineering candidates participate? Samyak, for most of our courses, yes, even non-engineering candidates can also participate. Only a course where specific engineering or math stats background is desired is the certificate program in financial engineering. That's actually very math savvy. But for the other courses, though we have a lot of mathematics statistics in all the courses, the AI for finance, the algorithmic trading, quantitative finance, and risk management. But if you see the minimum eligibility criteria, you'll see that we require people from any kind of graduation background in commerce, economics, finance, engineering, mathematics, statistics, science with mathematics. So yes, non-engineering students are definitely eligible for most of the courses, barring the finance engineering program, which is very math heavy. But other than that, all of the courses can be done by non-engineering students as well. And yeah, I mean, if you want to discuss in more detail in terms of your background, and again, we can definitely guide you, suggest you what is the right of, or the right kind of, path you can choose. So you can call us, and we would be very happy to discuss and guide you one-on-one. All right. Uh, Deeptesh, start days coming up for CP AIRM course. Yeah, that actually the next cohorts would be announced soon, but that's part of the AI for Finance course. And just to discuss and like check the, I mean, maybe you have the background, because AI for Risk Management directly is a course which requires you to have a solid background in data science, machine learning prior to joining that. So maybe we can have a quick discussion, and maybe we can uh, see the suitability of the program for you. So yeah, we would call and discuss with you one on one. Hello, sir. It's from Ankit. Hello, sir. I'm coming from a data science background and want to pursue my career in quants, and I'm interested in derivatives and trading. Which course should I take? Okay, Sanjay, I'm answering this question as well, right? So ideally, it should be, if you, I mean, certificate program in financial engineering or quantitative finance and risk management. But I mean, please do reach out to us, and I mean, we'll like to have a one-on-one discussion, and basis your background, we can definitely suggest the right course. All right, my myself Barguna, right now working in TCS in capital market and having completed NISM derivative examination as well, but I don't have any idea about the future which has fit for my career. Would you please assist on which one would be a fit for me? Um, Again, given that you are in the capital market space, Barguna, there can be two kinds of courses that can be looked at for you. Either the algorithmic trading course, because for the people within the capital market, automation of trading and learning about systematic trading becomes very important if you have an interest in continuing to work deeply into the capital market space. If you want to maybe expand your horizon, then other areas that can be looked at, I mean, one, AI, machine learning, data science is something which is becoming in every industry, including the capital markets. So you can look at this AI for finance kind of learning, where you learn data science, machine learning in deep, and maybe in the last part of the course, you can choose either AI for trading or AI for derivatives as your specialization, right? So again, we would like to have a more deeper discussion on this. Maybe one-on-one call would be desired. So we'll call you, and we will discuss there. Milind says, Milind here, if you're open to it, I'd be honored to have your guidance as a mentor and learn from you as I build this. Okay, the follow up to that question, Sanjay, again, it is for you. So, I mean, if you can guide him, then he'd like to actually maybe do a little collaborative work.
Yeah. Yeah, thank you, Milan. So for this mail ID info@iiqf.org, you would drop a mail and it will reach out to me, and then maybe we will connect to deep dive into that proposition, how to collaborate on a research in private credit space.
Wonderful. All
Yeah,
right. So, yeah, I mean, email to us, Milind, your coordinates, and I'll be very happy to connect you to Sanjay, and then you two can actually work on that. All right. So thanks, Sanjay. I mean, that's actually a great I mean, help from your side. Okay. Now, Siddesh, the question I did not understand it in detail, but again, maybe I mean, your question is how far this course is different from quantitative financial engineering. So when you mentioned this course, I could not understand which course actually. However, in any case, what I'd like to do is this question maybe we would like to take it on one-on-one. So we would definitely get in touch with you and discuss your this particular query in detail, and we will discuss. I mean, which course you are talking about. All right. All right, cool. So I think other questions are more of repetitive in nature. So I mean, I think we have covered almost all of the questions. Not all of almost. I mean, we have covered all the questions actually, right? So maybe we can wrap up the session for today, Sanjay. And first and foremost, thank you once again for joining. It was really a very insightful session, very eye opening, and thanks for your patience in understanding. Sorry, in answering all the questions, right? So thanks so much.
yeah. Thanks to all the participants for your active participation. We at IIQF put a lot of effort to think maybe how we could spread awareness. on this topic, and maybe just stay tuned, on the social media sites and maybe our web page for upcoming webinars. And be rest assured that these a kind of this would provide a kind of tune in opportunity for you to understand where the market is going. We keep conducting topics, a variety of topics on algorithmic trading, high frequency trading, derivative pricing and valuation, risk management, maybe a lot of different flavors, even some new topics like climate risk, ESG modeling. So just keep tuning in, and I think maybe it would also help you to shape up your career, because we were on a career topic, and to take decide the career trajectory for you. The more you become aware, nothing is irrelevant. When you are in financial sector and industry, it's an ocean. And maybe see what interests you and where you would like to passion, which territory you would like to passion. The answer will come in a exploratory spirit. The more you explore, the more you get to know. Yeah.
Absolutely, absolutely. So keep track of all the future webinars. That we would be doing, and we will keep doing over the next months as well. So it will all be posted in our social media handles, in our website, and of course, you'll be intimated over emails and as well. So yeah, look forward to see you on the future webinars. And thanks very much. Thanks once again, everyone, for joining in. Thanks for your time. Yeah, look forward to see you again in the next webinar. Thank you.
Yeah. Thanks a lot.
Thank you.